Hello traders, Gary Wagner here. Just about 10:25 in Honolulu, 4:25 in New York. It is Friday. Happy Aloha Friday, as we say on the islands, September the 2nd, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combined that with trending markets to give you an overall feel or scope for activity this week in the markets, as well as our forecast for next week. A disappointing jobs report, which came out this month, expectations around 180,000 jobs to be added, actual 155,000 jobs added, sent the precious metals flying, stock market in a rally. Dollar, interestingly, went down at first, but then traded higher throughout the day. We did make trade recommendations to enter trades long in both gold and silver. We'll go over those as we pull up our first chart. But first, let's look at our basic price changes for the day. Gold, tremendous move up about $12 on the day, $1329.20 with a low of $1307 and a high of $1334. That, of course, is basis COMEX December contract. When we look at our New York spot, so to speak, $1324, $1325, putting it up also about $12 with a high of $1330 and a low of $1305. Silver really on a rampage today. First, let's take a look at spot, $1338, putting up about 51 cents. But look at the percentage gain, almost a 3% gain on the day. We did make a recommendation to enter a silver from the long side. And if we look at COMEX, 1948 is our current print. Same net change. And highs and lows are roughly 1882 and 1949 on the day. So traders, absolutely no doubt, an incredibly interesting week in the precious metals markets. For the better part of the last couple of weeks, though, gold has been trading under pressure. Once it hit these highs up at around 1380, we had this double top that came in. We saw this market under pressure. First, we had this compression triangle, which I believe would break to the upside. I was right about the break, a release of power, but absolutely wrong about the direction. This market came down and came down with a fever. But during the beginning of this week, and especially towards the middle, we talked about the fact that we had a critical level here, and that level was a 38% retracement, 1308 to be exact, and that retracement that we're looking at is from the beginning of this rally here at about 1200 up to this first top at about 1380, so about a $180 rally, a sizable rally in the market. Now, when we do that, we get two basic areas of critical importance that we want to take a look at. The first area that we absolutely want to take a look at, of course, is, as I said, the 38% retracement area. And then the next level, should the 38% retracement level, should it not have held, our sense was that it would probably correct to about a 61% retracement. And on that 61% retracement, that would have taken it to about 1266. However, that does not seem to be the case here because, as we noted yesterday, we definitely got a series of lows that came in right at around this area being 1308. Yesterday, we identified a candlestick pattern called an engulfing bullish. But to take that call, we have to have a confirming candle. A confirming candle on this particular type of pattern is simply a green candle, meaning that it closes higher than it opens with a higher high and a higher low. All three sets of criteria were met. We actually did issue a recommendation to go long this market. Traders taking that call got in between, it was a very, very fast market running between 1328 and 1323. It was extremely fast, so we put ourselves in at the top of that range. However, many of our subscribers should or could be in much, much lower. Stops have to be below these lows at about 1308. So we have marked our lows below 1305. And that, of course, is basis a December contract, COMEX contract. For those of you that are trading spot, 1301, put your stop below that. Your entry price is going to be more like 1324. Realize that right now there's approximately a $4 difference between spot and December COMEX. So traders, absolutely a phenomenal move in silver. You know, silver's just been on fire lately. Now, when we sent out our recommendation this morning, it's actually last night about 2:30 Hawaii time. That's when I've got to be up to see what the figures are on the jobs report when that comes out because of our time difference. But we entered silver from the long side at 1917 this morning. Our stops are below 1850. Just to give you an idea of what we're looking at, of course, reason for our stops, first of all, it is this basic support area, which is a 61% retracement. We want to make sure that we're covered just underneath this, which is why this number is 1854 and we're going below 1850. You want to make sure that you're under this area here. But the other thing that's absolutely noteworthy is look at how silver absolutely closed up near the highs of the day, closing at 1943. And that, of course, is basis spot. If we look at actual COMEX, the difference is about a 9-cent difference between spot silver and COMEX silver. So traders, as you can see, when we look at spot, 1942.3, and when we look at COMEX, let's go ahead and switch that, 1952 and a half. So again, maintain your current long position, 1917. Basis silver futures, COMEX silver futures, and then stops collectively below 1850 and 1841 if you are trading spot. So traders, a new part of our Friday edition is answering questions from our subscriber base on Fridays. Interesting question that we got today was about Elliott Wave and whether or not, although I use Elliott Wave predominantly for daily and weekly charts, if I feel they are a well-defined tool for intraday work. And first of all, to answer the question directly, I have used Elliott Wave with intraday charts, but they're really half a day, never really more than a quarter day. I don't really like to use them with 10 or 15 or 20 or 30 minute candlestick or bar chart, so to speak, in terms of the time interval. Realize that when R.N. Elliott created this technique, he created it and looked at daily and weekly charts. Now, the one thing about Elliott Wave is not a perfect system. It is a beautiful concept or model to kind of wrap your head around the way cycles build and move and price changes through time. But see, to me, Elliott Wave is not perfect. The Fibonacci number sequence is. That's absolutely perfect. When we look at that number 0.61, how that is really the number that relates to the building blocks of all things in nature, that's a perfect sequence. Perfect. Elliott Wave attempts to describe that sequence, and sometimes it's better and sometimes it's worse at actually being able to do that. But in terms of what I actually really like to use with Elliott Wave, these are candlestick charts, as you can see, but what I prefer just to look at what I would say straight Elliott Wave counts is to move to a Henkin Ashi or a Japanese average chart. Let's go ahead and convert that. And when we convert that, you might see why I prefer that. It tends to take a lot of trend noise out of the market. And so what you'll get is you'll get these defined rallies as solid greens. You'll get these consolidation areas as really alternating candle colors. You can see red, green, and so forth. Defined downtrends, pivotal candles such as the doji come into play. And then although this is our updated count, but although we label this as one is going to be composed roughly of a 5 or a 3 count. You can easily see that in a Japanese average chart. 1, 2, 3. It's as clear as can be. Now, from 1 here to 2 here, it's quite easy to see as an A, a B, and a C. And so you get a sense for the actual wave changes with the Japanese average chart. And so to answer your question directly, I like to use daily charts with Elliott Wave, and I prefer when I'm doing my analysis actually to look at Heikin Ashi charts with that Elliott Wave. I hope that answers your question. So traders, very interesting day. When we look at the US dollar, for example, early this morning as trading began, the dollar index itself was trading lower on the day. As the report came out, it actually spiked up to close up about 0.2% at 95.86. Traders, we are looking at a 13-minute candlestick chart here, and you can see how the market dipped as we saw the jobs reports numbers coming out, and then a subsequent rally following that, and then remain fairly flat for the remainder of the day. Now, interestingly enough, the effect on the dollar to gold I thought was interesting because gold had a tremendous day but still had to overcome dollar strength. Minor dollar strength, but dollar strength nonetheless. Take a look at gold, for example, the move up today about $11, $12. On that move itself, strengthening dollar actually took away about $3.30, but once you added in normal buying of gold, you added another $14.80, and that's how we came out with this net change of about $11.50. Traders, crude oil was higher on the day, up over 2.5% in terms of net change, $1.12 per barrel, having it close at 44.28. However, when you look at the weekly activity, I believe crude oil lost approximately 6.7% on the week, and I do expect it to continue trading either sideways or lower, at least for the next couple of weeks as summer comes to a close and we kick off our next season. So traders, a weaker than expected jobs report really diminished the odds of a rate hike this month in September. FOMC will meet later on towards the end of the month. In terms of probability right now, it declined about 20 points. Prior to the jobs report, the expectation of probability of a rate hike in September was about 40%. It is now 20%. December still stands at 40%. But irregardless, that change in perception about a rate hike absolutely fueled a nice little weekend rally and new month rally in the equities markets. Dow Jones Industrial Average trading up about 72 points to close at 1849, and in terms of net change, about 0.4%. When we look at the Standard & Poor's, over 0.5% gain at 2178, and then finally NASDAQ. When we look at NASDAQ, that was up about 0.4%. This, of course, is the NASDAQ 100 E-mini at 4796. So traders, no doubt, a most interesting week in the market, specifically gold and silver. Silver, once again, off like a banshee, trading up about 2.5% on the day. But as we showed you in the charts that we looked at earlier, we have seen some real support come into this market at about 1850, and this market is absolutely a runaway freight train. Gold also recovering after trading under pressure for the better part of a week, finding support at that key critical areas we talked about over the last 3 days, and then this bounce today, of course, triggering our buy signal in both markets. My recommendation, obviously, maintain your current long position in gold, maintain your current long position in silver, maintain protective stops in both. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for another daily update and review. Have a great weekend, a Labor Day weekend. We'll talk to you on Tuesday, for another daily update and review. Bye-bye.